All right. Well, thank you very much, Mark, and nice to see everybody today. Let me go ahead and get my screen shared. Mark, can you see that okay? Is that coming through
Yes,
good?
that's perfect. Yep.
Okay. And first off, I'll also apologize. I got a bad cold over the weekend, so between my voice and our cough may occasionally interrupt, and I've got a big water next to me, so I'll work my way through it as easily as I can. But today we wanted to talk a little bit about the basics of business valuation and the really the value drivers for businesses. And that way, when you guys are working with your clients, you can have a little better understanding of that. Um, Business owners, whenever I talk with business owners, I find most business owners do have an opinion as to the value of their business. Most often, it's not based in reality or not based in hard facts. Oftentimes, it's, oh, you know what? I had a buddy that had a business similar to mine, heating and air conditioning, and he was in Ohio and, he sold out 5 years ago for this. So I just think my business is worth that. Or I was at a trade show and I heard somebody saying they sold for 7 times earnings, and so I figured that's what I'm worth. And they just kind of get a number stuck in their head. And it may or may not have any relevance as to the actual value of their business. When independent studies have been done, I've seen many over the years that basically show they've gone out and they've actually asked people what their business is worth, and then they've gone and had an appraisal done. And over half the time, the business owners misjudge their business value by 50% or more. Now, I find it quite often that they overinflate the value of the business, but occasionally people also do understate their business value. Some of those people oftentimes are just the people that look at the book value of their company and go, oh, well, assets minus liabilities, I guess that's all I'm worth. And they fail to look at some of the intangible value that might have been created. And sometimes clients may say, well, why know the value of my business? Well, business owners actively monitor their IRAs, 401ks. I mean, we all get monthly account statements from our investment accounts. We see what our 401k balances are, when the economy has fluctuations and the news is freaking out because the Dow's down 10%. We all see how that impacts our statements and where our value is going all the time. But to be honest with you, for most business owners, their business is their single largest retirement asset. It typically dwarfs a lot of the other assets that they own. So shouldn't it be even more important for them to kind of have a better idea on what their business is worth and how to manage and create that value? A score report from 2022 that I saw just a little while back state that over the next 10 to 15 years, approximately 5 million firms that hold over $10 trillion worth of assets were going to be transferred. We're kind of getting into that back end of the baby boomer generation, transitioning to retirement. And so for the last several years, we've had an above normal trend of businesses selling and transitioning, and that's going to continue still for the next several years as the baby boomer generation continues to retire. So business owners who really want to continue to exit their business, they are facing increased competition for quality buyers because, generally you're going to have the same amount of buyers out there, whether you've got a million businesses to transfer in a given year or 500,000, you've got the same amount of qualified buyers. So it really is in times of high supply, it really is more of a buyer's market. And just purely in the law of supply and demand. And so really business owners need to kind of develop a strategic plan, not only to maximize value, but to create interest in their business and really make it stand out amongst the rest. You know, kind of like when you list your home on for sale in the market, you know, you want to make sure the window dressings are good. You want to make sure you got a fresh coat of paint. You want to make sure there's not a lot of deferred maintenance that needs to be done, and the same way applies to a business. You know, you want to make sure you're presenting yourself in the best fashion possible before you go to market. I've seen many different exit planning associations over the last several years talk about that, you know, when you really get into taking a look at the financial records of a company, 90% of the businesses that you start to look into don't have adequate records and aren't prepared to sell. You know, so many small business owners are managing their business to minimize their tax liability and only focusing on that, and they're not prepared to sell, or they don't have proper accounting systems, or you know, you guys have seen it all, I'm sure, over the years. And Mark, I know we've talked about many clients that you know, you take a look at the financial systems and go, wow, you know, there's no way you're going to sell to a buyer looking like this. We've got to do something about it. So, you know, when should a business owner start to plan for sale? 6 months prior, a year prior, 2 years prior? Most consultants kind of feel that really you need to start that exit planning at least 3 years prior to any potential exit event to help maximize your sales price. It takes a while to get the financial records cleaned up, to get things properly organized and stated, and to stop maybe managing it to minimize taxes and start managing it to maximize profit, and to get that history of strong earnings out there, to, you know, so that a potential buyer looks at a track record of cleaned up financials, which really helps to facilitate a sale. And that's where, you know, we talk a little bit about sometimes one of the main sellers' concerns are, if I start showing more profit, I'm going to pay more taxes. And they go, yeah, but that's short term. So let's say for the next 2 years, you're going to pay an extra 30 cents for every dollar of profit that you generate. So yeah, you'll pay some more taxes. But on the back end, if you're going to sell for an extra 3, 4, or $5 for every dollar of profit that you show, you can see where you're going to pay 30 cents to get 3, 4, or $5 on the back end, and yeah, that's when it starts to make sense a little bit for them. So, from my experiences, the most successful business owners do start planning when they actually acquire the business. You know, when you start a business or acquire a business and you always have an endpoint in mind, it helps you manage it more like a business as opposed to treating it like a job. To keep it as a separate business entity, to incorporate the mindset into all of their decision making and business opportunities, you know, to treat it as more of a return on investment mentality as opposed to how much can I make this year, really does help keep that kind of the business structures in place from historically, from what I've seen. When you start to talk with a business owner about value, really, you know, typically you're probably going to be coming in 2, 3 years in advance in a perfect scenario. And so one of the things that you need to do is you need to have a starting point. You know, what is the value today? And then you need to understand the time horizon. You know, is the person that you're working with just if they're planning on holding it for 20 to 30 years or transferring it to family members, then that's one conversation. If they're looking at kind of a quick turnaround, maybe they bought it and they're looking to maybe maximize, efficiencies and then turn around and spin it off in 3 to 5 years, then that's important to know too. Excuse me. A lot of time business owners, one of the things that people fail to see a lot of times, especially when they're working with financial planners and whatnot to help meet retirement goals, is they fail to really understand what their business value is. And as we talked about before, it's often their single largest retirement asset. So when you're working with the financial planner, they're modeling your investment portfolio and real estate and life insurance and everything else, but they take a look at it and when they say, well, what's your business worth? A lot of times they just plug in a generic value and don't really have any idea as to how accurate that is, which can have a pretty big impact on the end game when it is time to retire. So it's great to be able to use that to meet retirement goals. You can use this information to kind of help set your finish line value of what do I need to grow the business to before I can retire, considering tax impacts and everything else. And so, you got to start somewhere. You got to have that starting point to be able to get to your ultimate destination. One of the things that, obviously when you get a business appraisal, people end up with a value, people end up with a number. But it's a lot more than that, because when we go to value a business, we're taking a look at the historical operations, we're analyzing expenses and revenues and growth trends and making comparisons to their peers to see if they are exceeding industry average, trailing industry averages. And we really learn where a lot of the strengths and weaknesses of the business are. That does many things. One, that helps understand when you can identify the weaknesses, you see the areas that need to be corrected prior to putting it for sale. So you basically, all of the red flags that come up, you go, okay, well, you know what? All of these need to be addressed prior to putting it on the market in the future. The other thing that you can learn too is you really start to learn the value drivers of a business. So different businesses may have different drivers. Certain businesses and certain industries, maybe EBITDA is king in terms of earnings, where, trucking companies, for example, believe it or not, pest control businesses. Trucking companies typically are more of an EBITDA multiple. Pest control businesses, for example, it's a gross revenue multiple. So different industries may have different value drivers, and so it's by getting an initial appraisal, it also really helps a business owner understand what the real value drivers of their business are and where they need to focus to help create growth between kind of setting the initial point A to help them get to point B, where they can hopefully create a liquidity event. There's many different reasons to value a company. And when we first get involved with a client, it's very important to understand the purpose, because the purpose oftentimes will dictate what type of report we have to prepare. A sale to a third party is going to be one type of report. Kind of at maybe 3 years out, where we're just getting involved with a client, it's more of an internal use only report, which is going to be a different kind. Maybe they're looking to transfer some stock to a son or daughter that's coming up in the business. That's going to have to be an IRS compliant type of report. So it's really important to understand what is the purpose first and foremost, and then that oftentimes dictates what type of analysis we have to prepare. Another thing that's important is what is the valuation date? Typically for merger and acquisition purposes, it's always the most current financial information available. For internal management, like a lot of like right now, we get hired by a lot of clients who kind of at the end of a fiscal year, once they start getting their numbers wrapped up, their books closed out, and their tax returns done, they say, "Hey, let's value it as of January 1 of this year, so we can kind of draw a line in the sand as to what it's worth." If you're gifting your stock to a son or daughter coming up in the business, the actual date that the gift occurs becomes the valuation date. It doesn't matter before, it doesn't matter after, it's the actual date of the gift. And it's important to identify the valuation date because when we value a company, we can only consider information that was known or knowable as of that date. So, for example, when I was valuing a company in June of 2008, if I got engaged to value it in June of 08 and then the economy falls apart in August of 08, if I wasn't done with the report, but I'm valuing it in June because that's when they gifted the stock to their son, I can't consider the fact that there was a market crash and the economy, went into a deep recession because while there were concerns at the time, nobody knew when it was, when or the magnitude of what was going to happen. When we value a company, we typically also have to state what we are valuing. With your clients, most of the time you're going to be looking at a potential liquidity event. So are you going to be looking at a stock sale or an asset sale? With a lot of small businesses, asset sales are king, kind of, with what we see. But there are certain businesses that maybe have government contracts or things that are very difficult to assign or maybe aren't assignable where a stock value is needed. And so it's always important to define what are we valuing? Are we looking just purely at, an asset sale or a stock sale? And then typically we also need to know, is the entire company being transferred or is just a portion of the company being transferred? Typically for most M&A engagements, it's always a controlling value, but there may be some minority values needed when you're gifting stock to your kids, or maybe you're granting some stock to a key employee for kind of golden handcuffs to keep them around. Those types of values are a little different, where you will need a minority value. The other thing that's important to identify whenever we value a business is the standard of value. The most common standard of value that we work with is fair market value. Fair market value is defined as the value between a hypothetical willing buyer, hypothetical willing seller, both parties fully knowledgeable of all the relevant facts, and neither party under any compulsion to buy or sell. And it assumes a cash value or terms comparable thereto. Investment value is a little different. Investment value is the value to a specific buyer. Okay, so in where it really varies is you can consider most of the time investment value is for like a competitor. Let's say a competitor is going to be acquiring a client of yours. By acquiring that client, there's specific synergies or efficiencies that they're going to be able to create because now they're going to have better purchasing power. Or guess what? They can eliminate some overlap of employees because they don't need a controller because they have a controller, and they don't need a VP of sales because they already have a VP of sales. So they're going to be able to generate more income out of that business than a hypothetical buyer would. And that's when you fall into the realm of investment value. Now, typically that area is difficult for appraisers to work in unless we're working for the buyer and we can identify those specific synergies or efficiencies that can be created. There's three primary approaches to business valuation. And these approaches or there's many different methods underneath them, and I've listed some of the most basic methods, but there's an asset-based approach, an income-based approach, and a market-based approach. And under the asset-based approach, the most common are the net asset method or the liquidation value method. Under the income approach, either a capitalization of earnings method or a discounted future cash flow method is often used. And under the market-based approach, you've got a comparable transaction method or a guideline public company method. The asset approaches typically are only relevant for asset intensive businesses or businesses which are really fledgling and not profitable. So we'll touch very little on those methods. The income approaches, the capitalization of earnings method is a method where you look at the last typically 3 to 5 years worth of performance and use that as a proxy for the future. Maybe you use some type of average or weighted average of the earnings and then utilize that to derive value. A discounted future cash flow or earnings method is used when oftentimes in businesses that are more early stage and maybe the last 3 years are not indicative of the next 3 to 5 years because the growth pattern, they're on a growth trajectory that's only going up from there. And so typically you develop a 3 to 5 year financial forecast with some certain growth expectations and margins and whatnot, and then utilize those earnings and discount those back into a fair market value. The comparable transaction method takes a look at actual sales of other similar type businesses and how those might be used to estimate value. And then the guideline public company method, when you've got some larger businesses that we deal with from time to time, there may be multiples in the public markets for those types of businesses that can be used to estimate value. Again, we'll just briefly touch on the net asset method. As I mentioned, it's typically relevant for underperforming companies, asset-intensive businesses. One of the biggest drawbacks of the net asset method is typically most balance sheets don't have a lot of goodwill on it unless it's been purchased from a prior transaction. And so the actual goodwill isn't typically on the balance sheet. It's just more of a accounting exercise of what's your net tangible assets minus your net tangible liabilities. So it's typically carries minimal relevance. Here's just a quick example of how we would adjust a balance sheet to fair market value to estimate kind of an asset value. And in this instance here, you can see we've adjusted accounts receivable weren't properly reporting in QuickBooks. So we got their AR aging and adjusted their receivables to a net collectible amount as of our valuation date. They had a little bit of inventory that they weren't even inputting into QuickBooks. And then we adjusted all their vehicles and equipment to estimated fair market values per some equipment appraisals that they had to show where the book, the actual QuickBooks was just showing 19,000 of assets because everything was heavily depreciated, where the fair market value of the assets were really about 1.174 million. And then there were no adjustments needed to the liabilities. So the net equity value under an asset approach would be just over $1 million in this instance. The income-based approach typically is for closely held businesses, I would say it's the most relied upon approach. And it really goes back to Finance 101. The value of any investment is the present value of the future expected benefits that you're going to receive from that investment. It's most relevant for businesses that aren't asset intensive, and which is the majority of businesses out there, whether you're service-based businesses, professional practices, retailers, distribution companies, the list goes on and on and on. And the only drawback to the income approach is you've got to be profitable. Now, With that being said, we're not necessarily saying taxable income, but more of a normalized income, and we'll get into that in a little while. The capitalization of earnings method is most used when there is a bit of a track record, companies that are a little more mature and where past results are expected to be similar to future results. It's also oftentimes used for businesses that are quite cyclical. So a lot of construction companies that maybe it's very difficult to forecast income beyond the next 12 months. You may use more of a 5-year average that incorporates highs and lows that oftentimes construction businesses experience. What is normalized income? We use the term normalized income to represent what the income of the business is after you've removed all of the funny business, the discretionary items that the owner may run through, whether it be travel, meals, entertainment, country club dues, vehicles, boats, airplane usage, whatever it might be. And we also remove any non-recurring items. So I was just working with a company that had a fire in their warehouse the previous year, and there was a whole lot of one-time expenses associated with moving the inventory to a new warehouse and the repair costs and the non-recurring insurance proceeds and the non-recurring expenses and all of that stuff. And so anything which is distorting the profitability one way or another, whether it be via discretionary items or non-recurring items, we remove all of those, and that's what we call normalized income. A brief example of that I'll show you here. In this example here, this is a sample company. You can see their top line income before taxes per books. They were losing 160,000, 207,000, 62,000, and then they had a decent profit this current year. Some of the adjustments that we made to normalize income here were they were taking excess officer compensation. We always add back interest expense when we're valuing 100% because the buyer is going to choose to leverage it however they wish. They had taken a lot of excess set 179 depreciation, accelerated tax depreciation, and really their normalized CapEx was about 100,000 a year. There was some non-recurring insurance items, non-recurring insurance expense. They had some personal travel and entertainment and auto. They had some personal professional fees. There was a non-recurring employee benefit paid in 1 year. Then they had some other little discretionary items. They weren't charging themselves for some off storage rent that they were using because the owner owned it, but a potential buyer is going to have to either rent that from the current owner or go off and get their own third-party space. So we had put in an estimated rental for what that storage cost was going to be. And then they had a non-recurring gain from a sale of an asset. So you can see after we made all these normalization adjustments, they were much more profitable than what the bottom line was really showing on the tax returns. Once you kind of normalize the earnings under an income approach, then there's really two things to determine is what kind of earnings are we going to look at? Are we looking at earnings before tax? Are we looking at EBITDA? Are we going to tax effect? Are we not going to tax effect? And that affects what capitalization rate we select when we apply a capitalization rate to income to determine value. We also take a look at it and go, should we use a 3-year average, a 5-year average, a weighted average, maybe the most recent year? That really depends on what you learn during the valuation process. For businesses that have more cyclical, we try to incorporate a bigger average. For businesses that maybe are, for example, like a pest control business, typically the client deck grows and grows and grows and grows over time, and you get this recurring revenues that are happening. Well, typically if as long as you've been growing, what does your revenue from 4 years ago really matter? If you go to sell, it's more about what is your recurring revenue today, and oftentimes in those types of businesses, maybe just the most recent years is most applicable. Income is converted into value through what we call a capitalization rate. It's really what is the expected return that you expect for the investment. And a lot of people are familiar with multiples. Multiple, people say, oh, well, I'm going to use a multiple of 4. A multiple is just an inverse of a cap rate. So a multiple of 4 would imply a capitalization rate of 25%. Because we always divide the income by the capitalization rate to get value. So dividing a number by 25% is the same thing as multiplying a number by 4. A 20% capitalization rate would be a 5 multiple. A 33% capitalization rate would be a 3 multiple. And so capitalization rates are typically used by business appraisers, and they're developed through what we call a build-up approach to capitalization rate, where we take a look at rates of return of other types of investments and then build up to what we feel an appropriate rate of return should be for that closely held business, considering the alternative investments. Then typically we also use a weighted average cost of capital, because most people acquiring businesses are going to be using a mix of debt and equity. Equity capital is always more expensive than debt capital. And so we typically create more of a blended expected rate of return based upon current debt costs in the market and the expected equity return. This is just a very brief example of showing, in this instance, we took the earnings for the last 4 years, or basically the last 3 years, and then the annualized current year, created a 4-year average, applied a weighted average cost of capital to get the invested capital value of the company of right about a little over $1 million. And then this was an asset sale. So we had to make a conversion from the invested capital value to a value of only the assets that were being acquired, which in this instance was inventory, fixed assets, and goodwill and other intangibles. And so we had to make some adjustments to add certain liabilities that wouldn't be assumed and subtract cash and receivables that weren't being acquired to come to a value of about $900,000 for the assets in this example. The market approach is probably the most common one that people kind of go, oh, I get this one, because most everybody's sold a home at one point or another, or they've gotten their home appraised. And when they look at the home appraisals, the biggest thing that you see in home appraisals is the comps. Oh, my model that was the same as mine sold down, 4 houses down, sold at, $224 a square foot. So I've got the same square footage, same model, maybe I have a pool, maybe they don't, but you kind of get a general idea of here's what the price per square foot is, and then maybe we'll make some slight adjustments because, of pools or whatnot. And so most people go, it's comps. Okay, yeah, it's the same fashion in business. It's comps. These are typically reported to proprietary databases that we subscribe to. They're reported by business brokers, M&A people, intermediaries, accountants, whatnot. There's multiple databases out there, and we take a look at multiples paid for similar businesses and then use those to estimate value of the subject company. And then the guideline public company method, as we briefly talked about before, you got to be a pretty decent size before you can even consider guideline public company. We're not going to try to compare Microsoft to a computer business doing 8 million a year of revenue. There's just too many differences in economies of scale, access to capital. The businesses aren't even apples and oranges. You got to be somewhat in the ball game. So I find it pretty rare that we would use a guideline public company method for businesses doing pretty rarely under 100 million in revenue. You got to be pretty large before it starts to make sense. The relevance and applicability of the market approach really depends upon the quality and quantity of the market data available, and this varies significantly by industry. Certain industries have a lot of information out there. Dental practices, a ton of information. Restaurants, a ton of information. Um, you get into contractors, heating, air conditioning, electricians, concrete. I mean, it'll vary by industry. Manufacturing businesses, there can be quite a bit in certain areas, hardly any in other areas. And so you really the applicability of it and how much reliance we can place upon it as a business appraiser really depends upon the niche in which your business operates. It's also more difficult to apply to companies that have multiple operating segments. So if you've got three different lines of business in there, right, kind of really all three different niches or industries, it makes it harder to apply a market approach because maybe only 30% of your business applies to this multiple, maybe 40% of your business would have this multiple, and then maybe the third niche, there's really not even enough data to compute. So it makes it hard to create what a blended value would be. Here's an example working with a pool cleaning service business, and there were two databases that we pulled a lot of transactions from. This just summarizes the median information from them as opposed to listing 341 transactions. But you can see that the multiples were anywhere from 12% of revenue to 1.48 or times revenue, or 148% of revenue, with the average and median being around 63-64% of revenue. Based on their size, their profitability, we thought 75% of revenue was an appropriate multiple. And in this instance, when we were looking at a 3-year average revenue for the company, because it had dipped and it did have some dips, they had some issues, so we needed to use a 3-year average. They were coming to, in this instance, we were also doing stock values. So after we applied our multiple, we had to add other assets that weren't included in the asset values generated by the multiple of revenue, and then back off any liabilities to come to a value of about 2 million here. Rules of thumb, those are the three main approaches. Some people talk about, they may say, well, do you just have a rule of thumb for the business, just so I can maybe get even a general idea of whether we're looking at 2 million or 10 million? Rules of thumb do exist. They're not available for all industries. Typically, you find them in the industries where there's the most transaction activity. As I mentioned before, there's a ton of transaction activity for restaurants, dental practices, CPA practices, and so there are some general rules of thumb. They can be very dangerous and they don't take into account company specifics. And they should never be used as a standalone valuation method, but you can occasionally use them as a sanity check on results of other methods. And, one example I'll give is, let's say valuing two different architecture firms. They've got identical revenues. Let's say they're both doing $2 million a year in revenue. And let's say the rule of thumb for architecture firms is 70% of revenue. If you just take a look purely the numbers and you apply 70% of revenue, you say, okay, well, they're both worth $1.4 million. But if you dig into it a little more and you find out one architectural practice gets 80% of their work from one key referral source, whereas the other one is very diversified, obviously that's going to affect the multiple because of the concentration issue that it has associated with one referral source, and the multiple is going to be a lot lower for that practice. So that's just kind of one example of they can be very dangerous because they're very narrow scoped as to how you apply them. Also comes into play too that kind of goes beyond the value is how the purchase is structured, and that can impact value. Fair market value, as we talked about earlier, it always equals cash terms or terms comparable there too. Is there an earnout provision? Is there a note? Is there a carryback? Are the terms on the debt at market rates? All of these things can be used in negotiating a deal, and they may influence what ultimately is paid. If there's an earnout, maybe it gives the potential seller the ability to earn more over time, but only if the future performance is there. So that those are things that are always looked at when it gets down to the nitty-gritty of the transaction. Also, the transition period agreed to between seller and buyer. Seller's like, here's the keys, I'm out. I'm not going to train. I don't want anything to do with it. And I'm willing to take a lower price. Then he's going to be penalized for it. But if he wants to maximize value, there's typically going to be a transition period that's built in when the sale occurs, where there's a consulting arrangement that allows for the most successful transition of the business over a period of time. And then obviously non-compete agreements can have a significant impact on the value of a company. The one thing I'll just briefly touch on, and this is primarily when a business owner is not transitioning it to a third party, but instead it's kind of staying in the family, and maybe a son or daughter are taking over. And it's really more about estate planning at that point for your client, as opposed to succession planning and maximizing value. Because a lot of times where maybe the business owner is become independently wealthy and they're like, you know what, we really don't need to maximize the sale of the business. We instead want to transition it to the next generation. When you do that and you're transitioning value to the next generation, it has to get reported to the IRS. The goal most of the time, especially if gifts are being used, where you're gifting it to your children, is to not have to claim any more value than you need to. And so most attorneys will have them transfer minority positions in a business over time. When you transfer let's say a 30% interest in a business, there's discounts that come into play because the buyer of a 30% interest doesn't have control. That's called a minority interest discount. They can't set management decisions. They can't decide when distributions are made. They can't do any of that. So there's a discount that we're able to take. Also, when you transfer a minority interest in a closely held business, when you're 30% owner, you can't decide to sell the business when you need a liquidity event. And you're basically at the mercy of the other shareholders. Hey, do you want to buy me out? Oh, sorry, not right now. My money's tied up, no interest. You're basically stuck with it until there is a liquidity event. So there's also a discount for lack of marketability that comes into play. And just a very quick example here. So let's say a business owner has a business that's worth $3 million and they don't need the money to retire. They instead want to pass it on to the next generation. Well, let's say the attorney says, okay, we're going to give 30% to your son or daughter to get them to start getting them some ownership as we start your retirement plan. If you just valued the company as a whole, 3 million, and said, okay, well, 30% is 900,000. But the value that you have to report to the IRS can consider these adjustments for lack of control and lack of marketability. So if we had determined the appropriate minority discount is 20%, these typically will range anywhere from 10 to 30, just depending upon facts and circumstances and company characteristics. And then the lack of marketability discount, which could vary anywhere from 10 to 40, just depending upon facts and circumstances and characteristics. But you can see that, in this instance, when the taxpayer had to report it to the IRS, they only claimed value of $504,000 was transferred to their son or daughter, which was a 44% effective discount from 900,000. Now this, I won't get into it a whole lot, but when you only have so much of your estate that is tax-free when you pass, the less that you have to claim to the IRS, the less that takes away from that at the end of the day when you do pass. Whatever exemption you have left is only what you have left that isn't taxed. So, and we can talk about that more. I'm happy to answer any questions about that if need be. A couple other things that I mentioned a little bit earlier is, sometimes we'll do valuations for buy-sell agreements. So maybe you might have a client that's, not looking to transition the business maybe anytime in the near future, but maybe they want to set up a deal with their partner. So if one of them gets hit by a bus, they don't end up with the partner's spouse being their partner. We'll oftentimes value a business to help set life insurance for a cross-purchase agreement. That's pretty common. And then incentivizing key employees, keeping very high-valued employees around, giving them some equity positions in the business, incentive stock kind of stuff. So really, what it comes down to is getting a business valuation really helps your clients determine a game plan. What's it worth today? If you were to look at selling it today, what could it sell for? And then how does that look in their overall strategy ultimately for retirement? And that's where then they can work with their advisors to, okay, most of the time people go, well, okay, I've got some work to do. I couldn't sell it today and retire and live off of the proceeds for the rest of my life after tax. So now we need to figure out how to grow it from point A to point B. And then that's where they can work with individuals like yourselves to kind of take what's learned from the business appraisal, learn the value drivers, learn the weaknesses, and work and grow and develop the business to help them get from point A to point B. One of the last things I'll mention is I've seen way too many times in my 30 years of doing this where I've had business owners call me, they haven't gotten good advice. They actually call me and they say, John, I'm burned out, I'm ready to sell. And I'll say, okay, are you working with anybody? Have you talked with your accountant about this? No. I Googled business appraiser. Right away, kind of the red flag goes up in my head and I'm like, oh no. So I can't tell you how many times I see where the person actually stopped caring 12 or 18 months before. And you can see it in the financials where their foot's off the gas. Their sales are already down 10 or 15%. They've taken their eye off the ball. Maybe expenses have gotten a little out of control. And now they're saying, I need out and I need out now. And they've already begun torpedoing their business and maximizing their value. And it's a shame where you see that, because now realistically, if they want to maximize value, they got to figure out how to get people like you involved to help them kind of turn the ship around, get things straight, get everything in order, and then put it on the market. And really proper planning and managing of the business is the best way to maximize, the sales price and to help a client ultimately meet all of their financial goals.